Give me just a second here. You ready?
Okay. Hi, everybody.
Okay.
Today is March 1st, 2018, and it is a webinar with the title of Scalping with the Market Profile. Hand it over to you, Jim.
Thank you. All right. Before we start the scalping portion of this, I'm just going to bring everybody up to date a little bit on how we have been seeing the market and a little bit about what was in today. That just I'm sure everybody out there's got an interest in the in the markets. So hold on, just 1 second. Hold on. I'm sorry. Just a second. Okay, just to give you a couple of thoughts. One of the things that we have been following is first of all, I say this is all of February, and then up until today. I'm sorry, this is on a weekly basis. Up until today, the market had been one time framing higher, 1 week, 2 weeks. And prior to today, the market was still one time framing higher on a weekly basis. The number that we have been using to indicate if there's change in the marketplace is 2693.50, which was this week, or at least this week's low until today. So you can imagine this without this week was one time framing higher. And we start off, and what happens so many times with markets, you get a break like we had. It was roughly a 12% break, and then from the high to the max. Then the market rallied back about 12%, about 10%. I'm sorry. Going into a couple of days ago, particularly these investment managers and some larger traders were all feeling very confident. They were feeling very confident because they were following price. And you hear them talk about, well, we think the market's going to hit new highs by the end of March, early in March, or by the end of March. So everybody was very, very confident that was going to happen. The market was one time framing higher. If you look at the structure, which we will in a minute, the structure of the market rally was absolutely terrible when you look at True Market Profile, which records the structure. So today, and you'll see it on the profiles, the market quit one time framing higher when we traded down through 2693. So now you've got an outside week going into tomorrow. To be relevant, it needs to close below last week for us to classify it as an outside week. But that's what you're looking at right now. But if nothing else, there is a change in the market, and that change is that we have stopped one time framing on a weekly basis. Additionally, let's take a real quick monthly view. And you see that we are, well down below the highs with a monthly view, where this is where March starts. Historically, what markets do, they go from bull to balance, and the balance usually takes some period of time. People thought this was going to be a straight recovery, a V recovery, very seldom. But now we're March is down here, so it looks like maybe a fairly traditional type of market where we rally up, balance, and then after balance, revert back to bull or back to bear, or revert to bear. So that's where we are right now. Okay, let's go take a fast look at the profile. And we're also going to show later in a couple slides some nice scalping trades from today. So the market, we all know by now what yesterday did. So we had a sharp break yesterday, and then of course that sets up a lot of volatility for today. So 26 Here's 26 26.93. 26.93 was last week's low, and that's the low we were watching so closely. The market, the point of control, the market tried to rally today, tried to rally, in F period in the afternoon. It couldn't raise the point of control. When it couldn't raise the point of control, that suggested maybe some problems for the market. So now the market started to kind of work to the downside, get close to the overnight low, get close to the the early morning low was right here at B period. This was the early morning low. Came down and took this out, and once it took it out, it hits all the stops. Now, I understand that there was, that the president talked about tariffs on two of the industries, and of course, that has its own emotional level that it can bring in to traders, particularly when traders are nervous. What I will say so far is anything I see, we have not seen indications of longer term money in the market. We see those trading pools that are in between, daytime frame and the long-term capital, but some of those trading pools are very large. Maybe some of them are upwards of $1 billion, plus they employ, heavy leverage. So I think the whole breakdown to 12% was mostly trading money, and I think the ride back up. The 2% down happened so fast that the long-time big money managers never had a chance to get out. So now they thought, well, it's going back. Well, now they got a little shock on their hands because now we're back down again. The market's probably only up or down, 4 or 5% for the year, whatever it is. So anyhow, that's what happened. That's what happened today. So where are we now? The market made a pretty good rally up here in L period, and we're now closed, down in below the center of the range, the center of today's range. Okay, there's the center of today's range, and we're well down below it. So when we open tomorrow, there's no assurance which way we're going in this market. The chances are we're going to open within today's range. Opening within today's range is usually a pretty good indication that we get a balancing day. It's a little early to know that, but the one thing I want to point out before we go to the formal part of the presentation is I want to show you. This is on our site. We have the New York Stock Exchange volume, and one of the things we point out is when you look at today's volume, and particularly the volume on the break this afternoon, when the market started to break, this is the really big movers around two, declined by 21%. Now people will say, yeah, but yesterday was end of month and end of options expiration, and it was high volume. Yes, it was, but then more downside. The market decreased 23% from yesterday, 24, 27, and finally, we don't have the actual final numbers in there, but 32%. Without the final runoff numbers, we're at 2194. Okay, 2 billion. Even a weekday is 2.8. So you had trader money, you had emotional selling this afternoon, but you did not have any serious money from anything that I can see. If you have serious money, then what happens is this volume goes up as the market goes down. So before we leave, go to the formal presentation, I will say that I think you want to be extremely cautious if you're on the short side of this market. This market can turn around and whip back at you very, very quickly. Remember I said this afternoon is, as Yogi said, it ain't over till it's over. I added, but sometimes the last inning can be very painful. So keep a perspective about you. More than likely we open in the middle of the range or someplace yesterday. Tomorrow we did not have high volume on the downside. It decreased considerably. be very cautious on the short side because it could be a dangerous place to be. Okay, let's go back. And Jen, you want to take over the slides from here? Jen, you there?
Yes, I'm here. I was on mute. Sorry.
Okay.
Just
Okay. You want to take over the slides?
Yep. 1 second. Can you see my screen?
Yes.
Okay.
Okay.
Great.
Do you make it larger or do I?
I can make it larger.
Please. Okay. So this is scalping with the market profile. And it doesn't have to be necessarily the market profile, but give you a little background. When I first started doing educational courses and what we call the intensives, I kind of turned up my nose at scalping. And part of the reason was I knew that so many people that tried to scalp had a terrible time doing it. And my time frame is not scalping. I'm one time frame beyond scalping. Scalping is a day time frame trade. So is my time frame. It's just one step removed from scalping, but still a day time frame trade. I mean, I do take trades overnight, but I also do a lot of day time frame trades. What happened, the longer I went teaching the course, the more comfortable I got with scalping, and the more I realized that no matter what I taught, I'm basically looking for 2 to 3 good trades a day. But what I realized is there's so many people in our courses that they want to trade, many times a day. So then I said, okay, you want to trade many times a day, you're probably going to lose money. But let's talk about how you do more than 2 or 3 trades a day on scalping, but how you do it intelligently so that you have a fighting chance in the marketplace. The next thing I want to talk about is kind of the history of scalping. Scalping was one of those things that was initially done on the exchange floors. The traders on the floor, they could buy on the bid, sell on the offer. You don't have that opportunity from off the floor. But the traders on the floor, they tried to buy in the bid, sell on the offer, and the exchanges even encourage that by pricing. So if you scratched a trade, no problem, you didn't pay any fees whatsoever. But that was to encourage the trading, encourage bringing liquidity to the floor. As it became more and more evident that the floors were going to go away, and that's incidentally when the market profile came along, because on the floors, a lot of what you did on the floor was by sound. You heard if the market went up to yesterday's high and it took out yesterday's high and the noise got very quiet, you knew there was no follow through, your hands went out, and that meant you were selling. If it went up and there was noise above yesterday's high when you took it out and it got noisy, your palms were towards you, that meant you were buying. And so that was the floor. Trading on the floor clearly had an advantage in the days of floors. You had some information ahead of time. You saw the larger orders coming into the floor, and a lot of times you could figure out where those orders were coming from. Was it Goldman Sachs, or one of the bigger firms, or was it one of the wire firms that had mostly retail traders? And that was valuable information. So the floors went away, and once the floors went away, a heavy percentage of floor traders tried to convert to screen traders or electronic traders. The majority of them did not make it. They still tried to trade the way they did on the floor. And they taught classes that way. But remember, once you're off the floor, you can no longer buy on the bid and sell on the offer. So you lose that, and that was a huge advantage. But then along came the algorithms. And I think the biggest place for the algorithms is in making those really tight markets. And what they were initially making their money by taking pennies and fractions of pennies, out of every trade or a lot of trade. And there was even times when the exchange would give them millions of a second advantage to know the order was going to hit the floor. So the traditional trader that thought that they were going to be scalpers couldn't do it, because they couldn't buy on the bid, sell on the offer. They had to do it just the opposite, and you had somebody getting in between them. Now, I know when I owned a discount, I was a trader on both the CBOE floor as well as Chicago Board of Trade, and I also had a futures discount trading firm. People used to call and say, well, if you tell me what the floor traders are doing, I will trade with you. And I used to laugh. I looked at the guy that was my president and I said, there's a credit risk, because the floor traders in a different business. So what happened, they tried to do that and it just wasn't successful. But the algorithms took over after the exchange floors. But now, currently, what I don't think will work is traders that are doing emotional stimulus response trades, trying to do scalp the market, make a point or two here and a point or two there. But what I think will work is seasoned short-term trades using day time frame references, and we're gonna talk about those in just a couple of minutes. Jen, let's take a look at the next slide. Okay, the personality of a successful scalper. They are decisive. They have no attachment to any trade whatsoever. If you are going to be a scalper, you should read, or think you're going to be a scalper, or are already a scalper and are not being as successful as you like or successful at all. You want to read Daniel Kahneman's book, Thinking Fast and Slow. This should be your guide. Now, he talks about the different makeups each of us have between, the ability to think fast and the ability to think slowly. Understand, there is no negative connotation to being either a fast or slow thinker. None whatsoever. It's just a difference in some people's makeup. The fast thinker is the potential scalper. They can process information very quickly, and they can make a decision very quickly, and be in and out of a trade, and we'll show you examples. The slower thinker does not want to try scalping, because what the slower thinker is going to do is if they get in the trade, they'll think about it, they'll hem and haw, they have to put a lot of information together. They probably didn't get in at the right price, and there's no place for them in the world of scalping. So the scalping it's a particular personality. They are very decisive. They have no attachment to any trade, and they are clearly fast thinkers, and they know it. Now, if people ask me, well, Jim, am I a fast thinker or a slow thinker? I know the answer immediately. A fast or slow thinker. If you have to ask the question, you are probably not a fast thinker. If you're a fast thinker, you have a pretty good idea of that. Okay, let's look at the next slide. Okay, let's talk about defining what are some of the day time frame references that I use in scalping. Half back. Half back is a dynamic reference because it changes throughout the day. There's half back for the first 30-minute period, but as we get range extension up or down, half back changes. But anybody that's a scalper, they already know what happens around half back. When a market, when you see a market in the morning stop at half back, well, it tells you a lot of things. One, half back is a short-term day time frame reference. If the market doesn't pay any attention to half back and things like that, then guess what? We've got longer term money and longer term traders in the marketplace. The longer term money has no idea what half back. If I'm talking about to an institution about half back, they'd look at me like I'm crazy, and they probably couldn't get me out of their office fast enough but it's a day time frame trader's reference. When the market is in a kind of a rotational environment, which incidentally about 85% of the days are rotational. It's only on trend days that, it's about 10, 15% of the time. But most of the time, we have some kind of rotational environment. We have a rotational environment. Half back becomes a good reference for us. Now, and that half back, that's dynamic. It moves. Now, the previous day's high or low, they're static. Those are what I call static references because they don't change. And there's always going to be some kind of interest or get your attention around the previous day's high or low. I mean, you watch a market for any period of time and scalpers will almost automatically sell the previous day's high or buy the previous day's low. Now, that doesn't mean they're right, doesn't mean they get much out of it, but that's kind of what they're built to do. And particularly those that came off the floors that were successful in making the transition. And I doubt it's more than 5 to 6%. Okay, now the overnight high and low, they are also static references. And you will see that those references bring in short-term traders have interest around those levels also. And they are very interesting. Now, particularly if you get, a lot of times you'll see finally they take out the overnight high or low. I'm sorry, they take out the daytime prime high or low, and the next thing is the overnight. And you'll see if you just watch it, you know what to look for. You will start to understand very quickly what I'm talking about. Now, another dynamic reference is this occurs on a trend day. The market, and it could be doesn't have to be a full trend day, but one time framing. Let's say the one time framing is up, so it's an advancing session. So the A period low is not taken out by the B period low. The C period low is not taken out by the C period low, etc. And you're one time framing higher. A scalper, a lot of times, will buy as close to the previous 30-minute low as he can get, or he or she can get. But it's a reference. So they go through it. They're out pretty quickly. But you'll see these markets advance like that all day. If you happen to live in another country and you're awake and you trade the overnight markets, you will see that the overnight markets trade one time frame trading. Sometimes I've seen it, 8, 12 periods. So again, it's a reference. One time framing prior on a declining session. So the A period high, B period does not take out the A period high. C does not take the B period high out, etc. So those are dynamic references because those references are always changing. And now we get the POC, and there's all kind of arguments. Do I use the volume POC or the traditional POC? I use the traditional POC because it includes time, price, and volume. Volume is estimated. The volume POC doesn't show time, and I think time is extremely important, but it doesn't make a lot of difference. Both of them tend to be references used by scalpers. And now we'll get to something else, and we'll show this a little later. Spike, highs, and lows. A spike is a move that happens late in the day, either up or down, but it happens so quickly that the market did not have time to validate if that spike was legitimate or not. But if you watch the markets, you will see, let's say the market's going up. That spike low is the same as any other short-term reference. You know where it is. Long-term money would laugh like hell. They have no idea where that is. But as traders, you know where that was. There was a late change in the market the night before. The settle. The settle is a static reference from the night before. Okay, that's where the market settled. And it's another classic scalper reference, as is today's open, or the day's open. It's not going to change, right? And you'll see many times, even later in the day, that the opening price is a high. You'll always see prices hesitate in that area. If they don't hesitate in that area, then you've got an idea there's something a little more powerful going on and a little longer time frame than the day time frame. So scalping works best on the day time frame. You can still use it. I showed in trending markets. You're just looking for slightly different references. When it's one time framing, you're looking for the highs or the lows. They work fairly well. Okay, Jen, let's take a look at the next slide. Okay, this is a slide. This is a slide from this morning. Can we make that any bigger? Or is that as big as it gets?
That's as big as I got it. Sorry.
Okay. All right. So if you look on the left-hand side of the chart, you will see the B period low. The B period low is the overnight low. The market comes down in the morning, and the early morning this morning falls. Well, the first one was A period. If you look at A period comes down, and it's 2 ticks above the overnight. Oh, I'm sorry, that's B. When A period comes, first of all, A period comes down, and A period is 4 ticks above the overnight low. Okay, that is a scalp. That is a scalper buy. Now it's 4 ticks, but you know, right near the overnight low is a traditional place where a scalper will buy the market. Now, later on in B period, the market comes down again, and it's still a scalper buy. In the first period, I'm sorry, we're talking about the same, in B period when it comes down. Now, let me clarify. A period was a scalper's buy, 4 ticks off the low, and you got one heck of a rally out of there. B period comes down again, 2 ticks, and it's still a scalper's buy. The reason I say a scalper has to be decisive, when that market comes down within a couple of ticks of the overnight low, which we said is a reference, if that doesn't work, you are out like a flash. And the portion that you don't want in that is the person that's going to overthink it. They can get really hung up in the market. And we'll go back to today's market and we'll see how that could have really killed somebody this afternoon, because we came back down there again, but there's a whole different story, different atmosphere. So those are scalper references. Now, A period, the first A period, which was 4 ticks off the low, it was one heck of a scalper trade. Now, scalpers don't stay in for the run all the way back to the high. I mean, most of them don't. Most of them, you know, the market makes a rally, they get out. They're not waiting around for the big move. Yeah, they should have, but they probably don't. The B period high, you know, a little less. They didn't get much out of it, but it was a legitimate scalping trade. So those are legitimate scalping trades. Now, there's scalpers, and when I address and teach, we're talking about scalpers, but we're also talking about my time frame, which is still day time frame. It's one step removed, one longer time frame than scalpers. It is still, these are legitimate buy areas for both scalpers and other day time frame traders with a slightly longer orientation. And why? They're great trades are when you can get into a trade and you can put a stop where you know very quickly where you are. The scalper very seldom wants to stop to take him out of the market. The scalper is alert. He knows, he watches, he knows what he needs right away. If he doesn't get it, he's out of the trade. He's very decisive. The next longer time frame is not as decisive. They have a tendency to overthink things. It's extremely important that they use stops. Okay, that's examples of particularly the A period scalp this morning. And you got another one in
And
B
Jim,
period.
I just wanted to point out about the volume too, that it was low as a new.
Oh, okay. Yeah, and that's another thing. But at the scalper, when you get the scalper, you don't have enough time to go check when it gets there to check the volume. I'm gonna show you some volume later, how it played into what happened this afternoon. I think I showed you that already. But but when you're a scalper, you don't have time to think about those, and that's not what you do. As a scalper, you're very decisive, very short-term oriented, and you're looking for those references. Okay, do we have another example? I think we have another example from today on scalping. Okay, what you'll see is I talked earlier, see the green dot? The green dot is the opening. And I said that the opening is another static reference, and it's another static reference that is very important to a scalper. And you'll almost always find that the market will hesitate around that opening. So when the market in B period goes up, it goes 2 ticks above the opening, and then it sells off. Classical scalper reference. And what we've been doing in some of the intensives that we're teaching is we're now talking about and pointing out scalping references. Again, constantly talking about the needed personality up there. But that's another example. Those are just from today. They're just scalping trades from today. And like I say, you're looking for a scalper, in my opinion, should be looking for some day time frame reference, so he has some certainty, and when he gets to that reference, he acts very decisively at that reference. It either works or it doesn't work. So many times these things work. Now, let me go back for a second. I'm going to skip back to where we were the first time. The scalping trade in the morning worked. It worked in A period. It worked in B period. Now, there's some other kind of thought that goes in here. And that is, and even a scalper is entitled to, have a little better understanding of the market. The low this morning, first low was 4 ticks off the overnight low. The second low was only 2 ticks off the overnight low. Now, people asked me as we were doing a session this morning, they asked me, is that a legitimate reference? I said, is that enough excess? I said, yes. 2 ticks is enough excess to trade on. Is it the best? No. So you got 2 ticks off of the overnight low. That is legitimate excess. The market rallied substantially from there. However, when you're making your observation, that certainly isn't the same as something that was 4 or 5 ticks and it came out there very quickly. So you make a notation. This isn't a particularly strong low. It was good for the morning. It went quite a bit higher with short-term traders, but it came back and roared through it this afternoon. So it is something you should observe. It's something we talked about today. We did 2 webinars today, two educational webinars today with the group, and we talked about that in both occasions. All right, let's take a look at the next slide. Okay, what we're going to show you here in a couple minutes. Now we have not rehearsed this, so it may not work, and we may have to leave it very quickly. But one of the things that we are doing in the new intensive course, Jen, who you just heard her voice, and another partner, RJ, they are doing a recap every day, and the recap runs, up to 20 minutes, can be 10 to 20 minutes. And what it does, it takes you through the day, rehearses the day, lets you review the day. You can stop and look and think about it. It covers the market. It covers all of the day. And I make post throughout the day commentary. We have a one-way chat where I can type in my screen and the chat comments appears on your screen. So you can see what my comments are. And then they were trying to match those comments to the video so you can see exactly what the market was doing at the time it happened. So it does two things. If you're not there that day or you've got a day job, you can go back and review the market. Or, if you want to go back and rethink the day, see what really went on, you can use this. I write a daily recap every day, but also it's not nearly in detail as this is, but this gives you up to a 20-minute video, and you can stop at any place to really get a better idea what went on in the market. So it speeds up your learning. You can see all of my important live market comments integrated where the market was when I mentioned them. Build a habit of identifying fast and slow trades with examples pointed out in the videos. Whether you're a fast trader or a slow trader, the video shows you if we pointed those out during the day. You'll also learn to see and identify important nuances. And they are nuances. A lot of times they're nothing more than a wider spot in the road, so to speak. It's some part of the profile that moves out to the right fast farther than the rest, and it just sticks out like a sore thumb. So, it's very important for that. Now, if you miss, for example, the morning webinar, you can review how the profile developed and what happened during the trading day in approximately 20 minutes. Jen, are we ready to show one of those in abbreviated form?
Yes.
Okay. Let's give it we've not rehearsed this, so let's give it a try.
Mind you, this is a very, very abbreviated form, and let me make it large. Can you see that there? Okay, so basically, I tried to shorten. I had the whole trading day in a 20-minute synopsis video, and then now for the purpose of this webinar, I'm basically extra speeding it through. So I apologize if you can't read everything because it's so quick, but this just gives you an idea of how we're doing them and integrating it so that you get the condensed version with all the important things pointed out to you.
But you do have a couple exampents on there of scalper trades that were pointed out, right?
Yes. Yep.
Okay.
So I will.
And we'll stop at those.
Yeah. But I just want people to get a feel for how they are. Sometimes I'm having to speed through them faster, like if it's just kind of slow, because I'm trying to keep these, keep them to 20. I don't want to have to ever go over 25 minutes if I don't have to.
Okay.
But you can see how we're pointing out things out as they're happening, and then I can skip forward to an example.
Okay.
But this was an important part here too, actually. Hold on one second. Right here. This was one of the trades that we pointed out during that time.
Are you a fast thinker that can make a quick decision without any hesitation? Shorting near yesterday's high / settle would be considered a fast trade.
Right. And the thing too to also point out to people is that we're also pointing out, when it's not wise to do a trade. I mean, it's, that's a nuance in itself, right? When the context is that, chances are you're going to get run over if you do this trade. It may be you think it's a fast trade, but the context says, maybe you shouldn't be doing it because the chances for it to be a losing trade are higher.
Okay, but you see on the example in front of us, a period went up to the previous day's settle and one tick below the previous day's high. That is a fast trade. Okay?
Okay.
And that's why we use that. Okay? So let's go on. We've got another example.
Yeah, I'm trying to fast forward here to it.
Those are, when fast forward, those are cutouts when I may be pointing out something else that's not really relevant to the fast trader.
Yeah, I'll post this right here. This was one of the trades you pointed out.
Okay. And what was this? February 27th, at the market continues to hover around yesterday's half back. Oh, okay. Okay, there it is.
And then I
Let's
have
see.
another one as well.
Okay, where are we talking about? The D period high?
It was, yes, because of the overnight
Oh,
the overnight lower.
the overnight low. Okay, the overnight low was a reference. So E period came up one tick above the overnight low, and then the market traded off. Again, that is a fast trade. Now, let me point out that if you look at the profile on the right, you'll see that the day in question here, which was yesterday, is taking place inside a previous day. So in other words, the market is in balance. When the market is in balance, meaning it's within the previous day's range, trading is likely going to be very different. Trading is likely going to be much more agreeable to fast trades because the market is in balance. So in other words, in balance within yesterday's range, and that means that there's no really significant change relative to yesterday. Now, traders trading in that environment, they are going to use almost every visual reference that they can find. They're going to use halfback. They're going to use the overnight low. They're going to use the previous day's high. They're going to use the previous day's low. They're going to use today's halfback. They're going to use overnight halfback. They're going to use very prominent points of control from overnight. They're just, that's just their world. Now, traders that try and use these same references sometimes when the market is out of balance, meaning we are above or below the previous day's range, they may be in for quite a problem because they haven't recognized that the trading atmosphere has changed from one day to another. In balance is a totally different way of trading, totally different atmosphere than out of balance. Okay, what else have we got there?
I just want to point out a small correction that this was Tuesday.
Tuesday. Okay, I'm sorry.
I just want to make that
yeah,
correct.
that was Tuesday. I'm sorry. So that was Tuesday. But it's the same. It's the same thing. So you see, the E period high fades right at the overnight low, and then the market sells off. There's no great science about it. It's just learning it, and it's what I call a lot of times calling chunking. You learn to take that information in. It's very similar. The example I always use to drive people nuts is when you first back a car out of the garage, it's very slow. You check the mirrors, you check what's in back of you, you start up, you look back. You've done it a few times, you back out faster and faster. Chunking is when you get to the market where you really can look at a market very quickly and you'll see half back, you'll see the opening, you'll see the previous day's high and low. You will see all of those in a second. In less than a second, those will just pop into your mind. It takes some training to do that. You have to know what to look for, but they are there, and it certainly adds to your understanding of what is available for trading. Okay, is this for it for
Yes,
this, right?
this is it.
Okay.
Yeah.
All right. Let's go to the.
So this is where the next trade was, and both a slow trader and a fast trader had an opportunity to do something.
Okay. Now let me ask you. Hold on. Oh, because it was near. I'm not caught. Slow trade opportunity to sell into the rally that occurred from the 3-week high. Help me. I don't remember right now what that trade was.
The market tested 2763.
Okay. I'm sorry. My memory. I just don't go back and remember.
Let me hit play
okay.
so you can see how it develops.
Okay. Okay. Well, we can go. We don't have to go there. I don't recall it right now. I may
The
have
fast
quoted it at
trader
the time.
could have bought here basically
Okay.
because that's at that
It's
3 week high, right? So
oh, okay.
the
The
fast
three.
trader
I'm
could have
sorry.
bought.
I'm sorry. It doesn't show. I'm sorry. It doesn't show on the profile. That's not where it came. I'm sorry. That's where it was. It doesn't come from the profile. 2363 was a reference that we were using because it was the 3 week high. Last Friday, when the market went wild on the upside, it took place when it rallied above a certain level, a 3 week high. When it came back to that level, it rallied again. When it went above it on Friday, when it came back later, it touched down there, and that was another buy point because they used that reference point off of the bar chart the same as they use a day time frame reference. Okay, before we go on to anything else, let me take as many questions relative to day time frame scalping as I can handle.
Okay. Are there any smaller time frame charts we could look at to see how the market approaches these levels?
No, they're not. And I do not use I do not use anything less than 30-minute charts. I've been around 40 years. And I know a lot of people, they use 5-minute charts, they use 2-minute charts, um, they do a lot of volume analysis, and I have never found that to be helpful. Um, I find the references that are visible to the most number of people to be the best references. Traders are very visual in what they do. And as you get accustomed to watching markets, you will recognize what I recognize very quickly, how visual the traders are. Just like when we were showing you this morning. Can we go back to this morning slide?
This morning slide, the
Yes.
PowerPoint slide?
Yes.
Okay. One second. Let me exit out of it.
I'm asking the impossible, but that's all right.
No, if I can just get my mouse to go where I need it to go.
Okay.
Let me pause this. Which slide did you,
I want to show the example of today's.
this
Uh,
one?
okay, right there. Thank you. So when you go down to the overnight low and the early morning low, and you leave 2 ticks down there, it shows perfectly on a 30-minute chart. I don't use anything less. You can use 3 minute, 5 minute, and you can do all kind of analysis. I don't need it because I think I see more. How many people are using all the smaller stuff? And most people, not all, a lot of people use the smaller, but a lot of people use the bigger charts. And if you ever watch what happens on the change of time periods, of 30-minute periods versus 15-minute periods or anything else, you will find that the greatest activity takes place around the change of a 30-minute bar from one period to the next. And you'll see that overnight low was very visual down there, very easy to see, both in A period when it was 4 ticks short and B period when it was 2 ticks short. And it happens very quickly. It happens very quickly. And I don't need I think anything else may get me too focused on very tiny information, and I won't get the trade done that I wanted to do. The thing I say so often, if what you are currently doing is working, then don't quit. If what you're currently doing is not working, then consider that maybe I have another way that you ought to think about. All right? Other questions, please.
As the POC didn't migrate lower later in the day and the POC is in the upper half of double distribution, will it indicate the downward pressure is not as much as the price is advertising?
Okay, let me go back. Give me the screen, if you will, for a second. Okay, so I have the screen again. And what we're talking about, what the question is relating to, is the POC, it's the green line there, did not migrate lower as the market broke sharply this afternoon. That is, if the market were really weak, the chances are that would have migrated lower. However, this happened after an announcement of a possible tariff wars and everything, and so it's a lot of emotional trading. So I think the bigger issue in here is what I showed earlier. I think it's more important than the point of control. It's what I showed earlier is that on this huge sell-off this afternoon, every half-hour volume saw a substantial decrease in every half hour of trading saw a substantial decrease in volume. The trade for the day, the total trade when the day was all over was 2.3. That doesn't get much lower than that. So, I mean, just even 2.8, I would call 2.8 on a very low day. This is 2.3. So what did you have this afternoon? You had a tremendous amount of emotional selling by traders, knee-jerk reactions. So that is an indication we can go back there. But let me go back to the point of control again. What I found, I mentioned it earlier, what I found most useful in the point of control today, and we were live when we were talking about this, so this isn't something cherry-picked after the fact. One of the questions came up when we had the training session, educational session. There was all these single prints in C period. The question was, there are so many single prints, Jim, do you think the market's going to go up and get some of those? I said, I really don't know. It doesn't feel like it. Well, the market went up and it got 6 of those single ticks. But then it came back down. And one of the things that I was watching, when the market went up, it could have pulled this point of control higher. This was the point of control before the market went higher. Actually, it may have been up here, but it did not raise the point of control. When it did not raise the point of control, when the market went higher, that is an indication that we didn't have any strong buying. Then the market came back down and started to work its way lower. And at that point in time, let me spread this. Oh, here, I'm spread over here. From the E period high, which took out some of the point of control, E, F, G, H, I, J period, one time frame lower. And at that point in time, so the point of control not rising, I thought was a far more important piece of information than the fact that it didn't lower. I put out, and I don't know if some of you saw it or not, but the reference we used it before. I think it was 26. What was it? 26.93. The 3-week low. And when that taken out, that's when the market fell apart. Not only did you get the announcement, but it also triggered other selling. What happens when you get an announcement like this afternoon? If the market really has a strong structural underlying, the market will still go down, but the amount it goes down will not be nearly as severe. When the market has poor underlying structure, the market can go down a long way. And let me show you, just talk about one case in point. This is the first time down here. This day, if you take a look how thin this day was, 1 distribution, 2 distributions, 3 distributions, 4 distributions. This was a really terrible day and an anomaly. Now, one of our clients, James, asked me 3 or 4 days ago, he was focused on this structure. And at that point in time, he's mostly a day trader, but he's focused on that structure and he thinks, well, should I plan on the market going back through that? my response was, and this was a question that came out while we were all on the program, and I said, you know, as a day trader, which you mostly are, if you focus on that day for today, it's probably going to make it very difficult to trade in the short time frame. That is information you need to carry forward for when the time is right. Well, today, if you were carrying that information forward, when the market, oh, this is the day, I'm sorry. I'm sorry, did I give you the wrong day? I think I did. It's this day right here. So when the market broke today, it came back down through all of that almost, took out all of these different distributions down to where the double prints are. So you see how that structure, when I'm talking about weak structure, that is weak structure. Now people ask, what is strong structure? It's, you know, the structure will be more, less elongated in this, but more not truncated, but less elongated in this. There'll be periods that'll be more than 5 or 6, you know, periods wide and a lot. But this is poor structure. When the market got bad news, it wasn't able to support the market. Were the market really strong and you got an announcement like that, the market may go down, but it's not going to go down nearly as far and nearly as dramatic. Okay, let me take another question.
Okay, 1 second here. Let me find. Today hit 2663 or 5850. How do you look at this low now?
I don't see anything, you know, it's a low. It's a low and it's got enough excess on it to be meaningful. So I'm just saying it's a low and we'll see if that low holds. We're currently trading, well, the settle, I don't know if the settle, but whatever after try, you know, 26.79.75. And so we've got a good low down there. I don't know if it holds, but we have a good low. I think there's a pretty good chance it holds simply because the volume was so low going down. What I'm looking at right now, I'm saying more than likely we open within today's range sometime tomorrow. And you know, if we do, then tomorrow's a balancing type of day. I mean, may have a lot of trade and be very wide, but the keep in mind also. Let me put the VIX up here. Okay, let me do the VIX on a daily basis. Okay, what you've seen, well, I'm sorry, let me go back first. Let me go back one more time. I'll look at the weekly VIX. So what you see on the weekly is the market went totally flat for forever. Then you get this big spike in volatility, but the volatility, you know, it trailed off, but it took quite a while to trail off. Didn't trail off immediately. Now, you had this volatility spike again, and then the market traded off. Last year's average was a little over 11 on the VIX. Recently, we've been trading back up about 17, 18, and then today, I saw the highest I saw today, it spiked back up to about 25. And it looks like right now we're at 22 and a half. So with that in mind, and then we'll go just take a fast look on the daily. Okay, there's the daily VIX. So you get that, and you can see that, you know, with it spiked down, moved sideways to the, you know, someplace around the 18%, 17, got down to 16, I think. Then we spiked back up today. So usually when you spike back up like that, you don't come down immediately. So as we come in tomorrow, we can probably expect that we're going to have, you know, higher volatility than the 16 to 18% that we've been having recently. So you got to take that into account. So we go back over and say, okay, where are we now? We're still below half back. Half back for today is way up here at 26. I guess that's 26.94. Call it 26.95. And so we're a long way from that. But as to the question for the low looks pretty good to me, particularly when it's based on how much how low the volume was on the downside tomorrow. Okay, other questions?
When you mention overnight inventory is long or short, which references or data are you looking at to determine this? As a follow-up, you mentioned there seems to be a good probability of a counter auction when the market opens. What occurrences would make you change your interpretation of the market that we are no longer seeing a counter auction, but we now see a genuine rally?
Okay, it's a lot of part to the question. Okay, first of all, we measure overnight inventory from the daily settle. So for today, we'll measure overnight inventory from tonight from today's settle. So if overnight inventory from tonight trades higher, then overnight inventory is long coming into tomorrow. What we have found, and this isn't any scientific real study, but we have found on average about 65% of the time there is a counter auction. So that means if overnight inventory is long, about 65% we get a counter auction, which means we get some kind of selling in order to rebalance overnight inventory. Now, the other part of that is if overnight inventory is long and there is no counter auction to that overnight inventory, then that's an indication that the market is really strong. So you got two sides. You got two sides to that. It's not just, some people, this makes it harder for some people because they say, oh, we didn't get a counter auction. Well, if we don't get a counter auction and it's long, that's a pretty strong market. The other thing, the thing that messes traders up the most is, say, for example, overnight inventory is long. You get a counter auction or a correction to overnight inventory that trades down, which means you're going to see price go lower. But once overnight inventory is rebalanced, the market then trades higher. That's the one that is the hardest for traders to deal with because they're so price oriented. They saw price going lower and they start following that, and all of a sudden the market turns around, trades back up, takes out the overnight high. So, I mean, there's nothing that's as simple. Everything has to be viewed in its context. Other questions?
Where would Jim have capitalized on the observation that the POC was not migrating lower if you're only trading futures?
That's not the question. Was if I related to today, if the market was trying to trade higher and the POC wasn't going higher, that's where you capitalize on the short side. That's where you can short when it doesn't go higher. You can short the failure at the high. You can short when it takes out the low. But you asked me if it's not going high, but it was today. Going high. It wasn't going higher today. That is what told me that we didn't have much strength in this market. So, that's the only way I can answer the question, is related to today, because that gives me the context. As I pointed out, where is today again? Let me get back to. Yeah, my point was that the market was trying to extend in E period, got 6 ticks out of there. The POC had a chance to go higher, but it didn't. When the POC didn't get higher, you have no strength in the market. So you could have, depending on how adept you were, you could have shorted when the market, couldn't take out the single prints. And then you say, monitor for continuation. Well, to monitor for continuation, you want the POC to not rise. If you short up here and the POC rises, you probably got a bad short. You short up here, the POC doesn't rise, you probably have a pretty good short. I mean, I can only answer it relative to today because that gives me the context. But the big thing is, if you do put the short on, how do you monitor for continuation? So there's a couple places you could have done it. One of the best places I think for the short 26.93 50, which we have been talking about. It was on all charts from last night, all this morning. When it took that out, it stops one time framing on a 3-week basis. More than likely you're going to get stops there. Now that coincided with news, so it's hard to say that's really what happened. But it's certainly, if it takes that out, I think you want to be short, and then if it doesn't follow through to the downside, then you get out. But that's a trade. That's something has changed when the been one time framing higher for 3 weeks. Now it takes out the 3-week low. Something has changed. Trading is about change. The biggest things that we learn about trading is without change, we have no real trades. So it's change that is our livelihood. So we're always looking for those areas where change is occurring. Okay, let's take 2 more questions.
Could Jim please pull back and identify weak structure on weekly or monthly charts?
No, there is no. I don't identify weak structure on weekly or monthly charts. What I do is I start off with the monthly chart to give me a perspective. I'm looking most traders, you end the day, most short-term traders are, very narrowly focused. And what I try to do is do the research by starting with the monthly chart, then down to the weekly, then down to the daily, then to the profiles. So I'm trying to take you from the smallest thing you're looking at up to something very large, just to change your mind, free your mind. Look at the monthlies, get a view. Okay, for example, I think it was 14 months, we one time framed higher. Okay, 14 months, we one time framed higher. And at that point in time, you keep in mind where the monthly chart's going, and you're saying, whether I like the monthly chart or not, we're one time framing higher. And if I'm a shorter term trader, you don't fight that. You don't fight that. And then I go to the weekly, then I go to the daily, then I come down to the profiles. If I, to take one look at a monthly ES, but I'll show you the things that can really mess up your mind. Okay, there's a monthly. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 months, we one time framed higher. From here, we really went to the upside. Now, if you ask me to look at that and I say, do I like that chart? I'll say no, because I don't think there's any support under it. I think someday we're going to come back and take it all out. But if you go try and do a trade based on what I'm saying, what I see, that's 1, 2, 3, 4, what? 1, 2, 3, 4 months. You're out of money by the time it breaks. I can look at that and say, okay, there's no backing and filling. You go up here, a little sideways, you got a little backing and filling. Notice that this stop just short of this, but you get too cute with this or too finely combed, and you're going to miss all the good trades. When they came, notice when this finally broke, it took out 1, 2, 3 months all in one very short session. So I mean, that's the thing that happens. But basically, I'm not trying to determine if the monthly chart looks weak or strong. I am trying to get a broader perspective. So I open my mind up. When I go to the bigger picture, I say, we're one time framing higher for 14 months. Think of all the biases you get out there. Boy, you've leaned something or you didn't like today. So, boy, this market really looks bad. I think this market's going down like hell. Well, you get that in your mind, and all of a sudden the market's still going higher, and you lose a lot of money. Get that out of your mind as the market closes. Go to the monthly and say, we're one time framing higher for 14 months. I'm not going to fight that. I mean, that's how I use the charts. Okay, other questions? One more, two more.
Can Jim give his thoughts on the bonds?
No, I really don't. I really don't trade bonds anymore. I did for a long. I traded bonds for years, but I don't anymore. But what I did do, um, I have commented to people, uh, is that that doesn't mean. Let me be clear. That doesn't mean that I don't look at bonds. For example, over here, the bonds broke, and I look at the 10-year. Bonds broke to new lows. No follow through. Okay, probably not the worst sign in the world. Probably not saying the market's really going to be weak. Now, the market got weak a couple times here, and the bonds didn't rally. Okay? Now the market got weak again, and the bonds rallied. So I'm aware of those kind of things. What's happened with yields? Everybody's so worried about inflation and everything else, but what's happening? Bond prices have gone higher, so yields have gone down. That's an inverse relationship, right? So I look at the bonds every day. I don't trade them, but I look at them every day for a perspective. Remember, I said trading is about change, and we're not getting any major change in the bond market. We had a chance to, it got down here. It could have really broken down, but it didn't. Okay, final question.
Is Jim carrying any positions overnight for tomorrow?
No. I did one option trade today and late in the day, but I closed it out. And let me just talk about that for just a second. Let me go back to today. This is something that may feel crazy to people. You're going way down here. Market's breaking down, down, down. I looked over at the volume. You saw me look at the volume before, and I saw how low it was. And I bought calls. I bought 26 net calls that expire a week from tomorrow. They're 26.90 strike price. And RJ, I sent you that. Thing for my trading account. What price did I buy those at?
1 second. Let me see. 1975.
Okay, I paid $19.75 for calls on at 26.90 strike price that expire a week from tomorrow. Now, volatility is spiked, and you may look at that and say, I can't buy that. That's just terribly, terribly expensive. And initially, I had no idea. I had no plan to do that whatsoever. But I looked down and I saw that the volume was drying up so much on the downside. I said, you know what? I'm going to pay that. And when I paid it, now I had a couple options. I'm sorry, let me change it differently. I had a couple of alternatives. If the market rallied, I could just sell them and take a profit. Or if the market rallied a little bit, I could sell the calls that expire tomorrow, which were also trading at about $1,000 at that time. And they, maybe they were 800 at that time, but they got to 1,000 or so, and they expire tomorrow. In what I decided to sell them. What price did I sell them at? You've got the schedule there.
26.50.
26.50. I had an order in at 28.75, and it got to 28.50, and I said, "Uh-oh, market's fading," and I just turned around and hit market and got out. So I mean, it was a decent little trade. So I did one trade, and I just said, I'm going to get out, step aside, and so I went home flat. What I have found that generally I am better off to go home flat and have for short-term trading, go home flat, have a clean mind in the morning. The other thing I found is that even if you don't have a position, if you watch carefully in the market, almost every day will give you a trade. I had no intention whatsoever of, turning around and going to the long side this afternoon. Wasn't even thought in my mind. And then all of a sudden, it's what I talk about is the trade coming to me. And when I looked at the volume and I saw how much that volume was drying up, I said, you know what? This trade feels right. And so I didn't look at a particular price. No, I'm not looking at a particular price or level. I bought the calls, and then the market went up. It felt like it was slowing down, and I let them go. So, and it did. It went up to I forget where it got to. It got up. Oh, it got up just about in here, and then it started to fade, and I just went out at the market. So, but I'm flat for today. Yeah, thank you for joining us this afternoon. I hope you found this of value. Thanks again. Bye now.
Thank you, everybody. Have a good night.